All right, it gives me great pleasure now to bring on board Prashant Jain of HDFC Mutual Fund to talk about where he sees markets ahead at. If at all, this is one year where the whole investment philosophy which Prashant and HDFC Mutual Fund has followed, which is that you focus on value and then don't try and time the market, in a sense has got endorsed. It's been a great year for the so-called value stocks, PSUs, energy stocks. They've really made a solid comeback. So what is the theme for 2022? Are we in for more of the same, or is it now time to hunker down your expectations, get very selective, because one side there's inflation and other side are heightened expectations? Prashant, fantastic to have you back on ET Now. Thank you for joining us. At the outset, wish you, your boys and your team members a wonderful 2022 ahead.
Good morning to you, Nikunj, and to your viewers, and I extremely warmly reciprocate your wishes and sentiments to you, your family, colleagues, and all your viewers.
Prashant, 2021 has been a year of dreams. We are calling it the year of imagination and fascination. Imagination
Nikunj,
given
can you
what's
be a
happened.
bit louder? I can barely hear you.
Okay. Can you hear me now? Is it better?
Hello.
Hi, is my voice reaching you, Prashant? Can you hear me now? Or you want us to?
Yes, no, this is perfect.
Wonderful, wonderful. Okay. We all are working from different locations. So I guess these things our viewers understand now that how COVID programming works. So Prashant, at ET Now, we are calling the year 2021 as a year of imagination and fascination. Fascination given what's happening in the digital world, and imagination given how new and new asset classes have got created. But whichever way I look at it, 2021 has been a year of fantastic returns. What is in store for 2022?
That's a great, and the most apt question to start this conversation. And I think the longer term India is always positive because it represents tremendous and secular growth. And one year, we have experienced it time and again, is always a challenge to take a view on. But I would still have a positive bias on the markets. And the reasons why I think returns should be positive over the course of this year. I think one, the valuations are reasonable. And some people felt that markets have run much ahead of the economic growth or fundamentals. I think that's not entirely true. Markets are now keeping pace with the fundamentals, and that is reflecting in both the trailing 10-15 year returns, which is around 12-13% around nominal GDP growth. It is reflecting in PE multiples. Markets are trading close to maybe 18 times fiscal 24. And in about 6-9 months from today, we will all start looking at that. These are maybe 5-10% higher multiples than long-term averages. But given the improving growth outlook and also the quite low cost of capital, I think these are reasonable valuations. I think the most important reason for optimism is that the growth outlook of both the economy and of earnings growth has clearly improved. I think while COVID caused a lot of social pain, a lot of pain to low income households, I think the economy actually has come out a winner through this very difficult time. The shift from Chinese manufacturing has accelerated. The China plus one strategy is a clear focus. The government is supporting it by way of PLI schemes and various policy initiatives. The profitability across the manufacturing sector in India, paper, sugar, textiles, metals, chemicals, across the board, we have seen an improvement. Corporate leverage in India is between 10 and 15-year lows. So I think the outlook for private capex is also improved. And world over, including India, I think governments are giving high emphasis on infra capex. And I'm sure we know how infra investments in India are accelerating. The flow of PE capital into not just the listed markets, but all in the unlisted markets, the startups, the infra assets, I think it is again uh, has positive implications for the growth of not just the economy, but specifically of the infra sector. The corporate banks or the bank's corporate NPA cycle has clearly ended. And we used to discuss it for many years, it will happen. But now I think one can clearly say it is over. So the outlook even there is quite decent. So net, I mean, I feel quite optimistic going into this year. Though I must also add that the returns of the last 1 or 2 years, the very high returns were the result of an extremely low base and also extremely low levels of corporate profitability in India. Corporate profits to GDP had fallen in fiscal 20, so I think almost 1.6%. Next year, we expect it to be around 4.5%. I think these very high returns of last 1 2 years because of the low market levels and low levels of profitability, I don't think should be extrapolated. And I think while one should remain optimistic, I think one should have more moderate expectations from equity markets. And I think if I think slightly ahead, maybe 3 5 years, I think this is a compounding type of market, which is what equities are actually known for.
Okay, so I'm going to break it for our viewers here, Prashant. What Prashant is saying is that when you invest, you look at three factors: valuations, which according to him are reasonable. If you look at earnings, there is scope for earnings recovery. And the third dimension is time. So don't look at 1 year. If you look beyond 3 4 5 years, there is a serious chance that you will continue to create wealth. Prashant, but if interest rates are likely to go higher, which is what they are, whether it's 25 bips or whether it is 50 bips, that is something which is our debate. Valuations will start coming down because the interest rate environment will always have an impact on the way how markets will start pricing equities as an asset class. Isn't that a risk of derating and risk of crunching?
Because I think that's again a very apt question, and this is the key risk that most people are highlighting for equities, not just in India but globally. But valuations, Nikunj, are not just a function of interest rates; they are also a function of growth. The growth outlook in India, both for the economy and corporate profitability, I think has improved materially. And while you are right, absolutely, that higher interest rates are not positive for equity valuations. I think the markets are pricing in some normalization of interest rates already. And but clearly, if the interest rates uh, surprise us on the upside, then clearly there could be some downside to valuations. And I myself admitted right at the beginning that valuations are 5 10% higher than long-term averages. So it's reasonable given the extremely low interest rates. The interesting point about India, however, is that long-term returns in a growth environment, in a growing economy like India, are far more dependent on growth than they are on some variations in interest rates. I mean, look at last 40 years, Sensex is up whatever 550 odd times. And in this period, we have seen many interest rates cycles. Interest rates have been high, interest rates have been low. Well, yes, while if interest rates go up really sharply, it could have a moderating impact on valuations. But if growth is persistent, if growth is good, I think one can still maintain and should maintain a positive view of equities. So, I mean, there is always a possibility that the year may end either flat or even marginally negative. But I think if you take a 3 5 year view, I think this is a risk which is reasonable, and to some extent at least it is priced into these
But why are you reasonably confident of a 2 to 3 to 5 year earnings cycle, which is what we have to understand? Because ultimately, that is the fuel for the market. What gives you the confidence that high inflation, high commodity prices, these will not derail the new economic cycle or the earnings cycle which has started?
because that's again a great I mean question. It flows very logically. See, I think the key is that One, inflation is a pass-through for equities. Inflation actually supports faster profit growth, because what is inflation? It is higher prices of goods and services. So companies which are selling these goods and services, they tend to benefit, at least in rupee terms, in nominal terms. Higher commodity prices, they help the profitability clearly of the commodity companies. And over time, the companies where the inputs are commodities, let's say the automobile sector or the consumer durable sector, they will pass it on to the end consumer. Because prices, let us remember, are not set by cost, but they are also set by demand and supply. So over time, these prices do get passed on to the end consumer, and that is what results in higher inflation. I don't think commodity prices would also impact the earnings growth rate. In fact, they may aid of the commodity specific sectors. As far as the other sectors are concerned, I think clearly the NPA cycle has ended. And given the economic cycles, the credit cycles of the capex cycles, I mean 6, 8, 10-year durations, I don't think we should worry about NPAs coming back anytime soon. The outlook for software sector is reasonable because the demand outlook is extremely robust. We clearly know what is happening in that space. The pharmaceutical sector, which has not done too well for a variety of reasons, there again, I think the new molecule pipeline is reasonable. There are cost saving initiatives underway. So I think from this low base, even that sector should do quite well. The consumer sector is a steady growth sector in India, and inflation clearly helps that sector. The utilities again is a sector which is not too, it does not vary a lot, and the growth outlook there should be reasonably steady. So I would say the profit growth outlook of India is quite reasonable, but we must also appreciate that the profit growth that we are seeing in last year, this year, and maybe next year, we cannot extrapolate that profit growth. Just to give you some, in a longer term perspective, around 10 years back, the corporate profits to GDP in India had touched an all-time high of around 8%. And in fiscal 20, we had dropped to a low of last 20 years of 1.6% profits. I think both were extremes for some of the reasons that we have discussed. I think that process of normalization should be over by next year, and which is what I said, we expect profits to GDP to be around 4.5%. I think thereafter we should expect broadly profit growth in line with the nominal GDP growth rate. And we again come back to the same point that these are markets where we should take a compounding type of approach to equity investments and not one-off kind of.
So, Prashant, at the beginning of the year, your portfolio positioning was tilted towards value. It is still tilted towards value. And there were two arguments. One, value stocks had underperformed, they were cheap, and the mean would revert. And second, we are at the beginning of the economic cycle. Value stocks have come back. Now, what is in store for utilities or corporate banks, or for that matter, PSU stocks? Do you think that mean reversion in terms of the underperformance is over?
I think honestly, I don't know. And I was in a way surprised by the valuations where some of these companies were trading. But I think we have seen reasonable correction in the corporate banks, reasonable correction in valuations. I think the next leg of corrections in banks in general, and some of the banks which are still cheaper compared to their peers. I think the important thing to watch out there would be the credit growth. This is one indicator in India which continues to remain quite low. The credit growth, I think last data point was around 7%. And as economy normalizes, as capex, industrial capex, infra capex picks up steam, as retail credit comes back to normalcy, I think the credit growth should pick up, and that I think will be supportive of good prospects for the banking sector. I think the only other piece where there is really good value, I mean, or where there is good value, as you pointed out, is the utility space. And or let me put it, sectors that have been impacted by ESG concerns. Views on this may vary from individual to individual, but clearly this is what has impacted the valuations, whether it is the power producers or whether it is the tobacco companies. I think I think this should probably be short lived. That's what I have felt for some time. Thus far, it has not played out, and I think time is the best judge of how long these low valuations can remain. But I, for one, believe that the current thermal power producers are extremely well placed to transition to the renewable power. They will play a very meaningful role because in renewable power, the main competitive advantage or disadvantage is the cost of borrowing. Some of these companies, the large companies, have the finest cost of borrowing. So over time, I don't see any reason why they will not become more ESG compliant or acceptable to a wider set of investors. And meanwhile, the power demand in India continues to grow. I'm sure we all read the headlines about the challenges in the coal space, the power space we had a few quarters back. I think one big question with not just India, but probably the world will seek an answer to over time is whether the ESG concerns will impact demand first or will they impact supply first. If you look at the global context, the investments into the oil and gas space have been quite low compared to where they used to be. And the population of fossil fuel vehicles will continue to grow for the next at least 5 years and probably the next 10 years, uh, despite good EV adoption. If you have not been investing enough in fossil fuels for last 3 5 years because of obvious reasons, and demand holds up or actually grows, then what happens to oil prices? What happens to the price of power? I think is an issue which is very interesting, and I will be keenly watching this space over the next few years.
Prashant, while you have a large exposure to corporate banks, within the financials, which account for 35% of the weightage, if I look at other sectors which have got insurance, that has not done very well. AMC stocks are also down. So why is that the entire financial space is suffering? Is it because this overdone, over-assumed fear because of fintech?
Nikuj, could you repeat that? There was some disturbance and I did not get the question clearly.
My question is that while we've discussed corporate banks and you've kept a position towards corporate banks for many years as far as I can remember, but the underperformance is just not restricted to corporate banks. Insurance stocks are down, AMC stocks are down. Do you think markets somewhere are getting overly worried about fintech disruption in some of these sectors?
So, Nikunj, one, I think this we are coming to a stage where this divide between corporate and retail banks, I think, is disappeared. And I think because now the loan books of almost all the banks is similar. That's point number one. I think you have to see. I mean, some of these banks have actually done extremely well. If you take a slightly longer period, but yes, last few quarters there has been some underperformance. I think it could be for a variety of reasons. One, it's always hard to forecast near-term returns. Number two, I think the move was very sharp. And that again leads to some periods of consolidation. Number three, as I said, the credit growth in India continues to be weak. So the lower provisioning costs have probably priced in, and now markets would wait for the credit growth to improve before taking a fresh look. And finally, I think there is some reallocation of portfolios must be taking place as a space is created for some of these new age or the fintech companies. I, for one, believe that the current environment where the adoption of digital banking is extremely rapid, I think will play to the advantage of the large banks. And these banks will be able to serve a lot more number of customers, a far larger suite of products. They will be able to even service very small customers, very small ticket loans they can disperse because it will all be technology driven. And I think it will also lead to lower costs for the banks. I believe actually the current environment is very supportive of large banks, and I feel they should gain share even faster than what they have done in the past. I think clearly banks that don't adopt digital will not do well, but I feel there is very little that the fintechs can do, which the banks cannot do, at least over time. I feel these banks, the large banks especially, are quite sustainable and actually they are well placed to benefit from the current environment.
Prashant, we had a conversation in 2018 on the same forum, and you said, look, I don't like NBFC stocks. They've mispriced their asset liability completely, and post the LNFS crisis, they all were caught with their pants down. As we roll into the next year, a lot of NBFCs have also become cheap. In fact, some of them, with the exception of Bajaj Finance, are trading at record lows. Are markets pricing in Are markets pricing in extreme pessimism there?
I think that's is the operating space too for NBFCs, in my very personal understanding, is getting severely constrained. In fact, it is reducing as we go along because in the past, the banks were constrained by either the physical reach or by, the high operating costs or lack of transparent data or inability to do collections in cash. I think all of that is changing in the digital world, in the data driven world, and where the role of cash is clearly reducing. I think there is very little spaces left where banks would not compete with the NBFCs, except in places where they say, I don't want to underwrite the credit risk. But that clearly will come with its own set of costs. I think this current environment, as I alluded to earlier, is very supportive of the large banks. And I don't think it is so favorable for the smaller banks and even for the NBFCs, unless these NBFCs have some unique, niches still available where the banks are hesitating to go or not in a position to go. And for example, if you look at the second-hand CV market, it has its own unique operating style. That is one space still where some of these NBFCs can have relatively less competition. But generally speaking, I would be cautious of the increasing intensity by large banks in many of the spaces where NBFCs operate. So I would be slightly more cautious structurally on that space.
Let's look at a sector, and this sector has really been crowned as the best performing sector. That's IT. This is one sector where, even though large companies are growing at a reasonable rate, mid-cap IT is where the P multiple expansion has happened. Why do we have such polarity? Because when a new cycle starts, uh, the market share and the talent and everything will migrate to large companies, and large companies are growing. Accenture numbers are endorsing that. Yet if I compare a P multiple of Infosys versus L&T Infotech and KPIT versus TCS, there is a sharp divergence. Shouldn't it be the other way around? Mid cap should be trading cheaper than large cap.
Because you are right, and this is what the view I've also held. But I think one thing has changed in this last cycle. Some of the unlike the previous years where the large caps were growing in line or actually faster than the small mid caps or smaller companies in these spaces. I think in the last few years, some of the cap companies have actually grown materially and sustainably higher than the large caps. And this is something that even I was not expecting. And coming to the valuations, I think the valuations, no doubt, are quite expensive. And the answer to that will lie how long and how much they can grow faster, for how many years. I think there, uh, no one really knows the answer, but I have seen that over time, as you grow, the growth rates moderate. And to that extent, I would feel that the what growth the large caps are experiencing, there is less downside to that than the downside to reduction in growth rates for some of the small mid cap. I would be slightly cautious, though I must admit that even the in the last cycle, I did not anticipate what has.
Are markets overpricing this EV re-rating? We understand that EV is reality and it will only increase in terms of our preferences. But EVs mean more competition, number of cars sold will not be higher, but EV will dent into the market share of existing players. How do you see the scenario changing here?
I think Nikunj, this is a theme that has very serious implications for the incumbents and over the medium term also for the country. So clearly, the government is extremely supportive of this transition to EVs, and that is evident in the way they are, or the way the traditional vehicles are being taxed, and the way there is taxation on the fossil fuels. Today, you can literally buy an EV and similar size, roughly similar sized ICE vehicles for roughly the same price. The ex factory prices are very different. The on road price is same because of the taxation. So I think the parity for the consumer, the cost parity is being reached. It is probably already reached in three wheelers. We are getting there in two wheelers, and over in the foreseeable future, I think it will happen even to the passenger vehicle segment. So I think this is a transition that I think will happen. There will no doubt be challenges. There will be many false starts, but I think it is a transition which is reasonably in sight. We can discuss, debate how much, how fast, but I think the direction is by and large very clear. And this clearly has implications for the incumbents. Companies that don't lead this transition, they are at risk of ceding the leadership to the new companies. And once you cede leadership, you cede market share. Once you cede the consumer mind share, the customer mind share, it is very hard and very expensive to get it back. To that extent, I think one should be cautious. Coming to the country, I think hopefully in 5 or 10 years' time, or maybe more likely 10 than 5, as the population of ICE EV vehicles in India grows significantly, and as our fossil fuel imports start coming down, this dependence on the fossil fuel imports should reduce. And that I think will be structural positive for this country. It is slightly thinking ahead, but I think as and when we manage to curb or reduce our fossil fuel imports, I think India has a chance of becoming a structurally current account surplus country. That I think can do wonders to this. That is what I was saying, that it has some very positive implications for the country for the medium to long term.
Closing comments, Prashant. It's been a record breaking year for SIPs and for the mutual fund industry. When you look at this trend of how SIP culture is increasing, number of demat accounts are increasing, do you think this is again like a multi year cycle, or this is more like a bull market phenomenon, more like Barsati Mendak?
No, Nikunj, I think this is as structural as it can be. I mean, you have been in the industry for a very long time. I've been here for 30 years, and I do recall clearly that 30 years back, 20 years back, even 15 years back, I mean, most of the time we used to spend just explaining the nature of equities, just explaining the what are SIPs, And I think collectively, the industry, people like you, media, the regulator, intermediaries, banks, relationship managers, I think collectively we can feel good that we have done a great job and we have taken equities to the common man. And today, I mean, no one asks you, should I invest in equities? No one asks, what is SIP? I think that's a wonderful achievement. And we always used to regret that the benefits of India's growth are being not shared by its own citizens, and the way foreign ownership was increasing relentlessly from zero to it went to almost 25% over 20, 25, 30 years. I think fortunately that trend has changed. So I feel extremely happy and that this retail participation is so strong, and I don't see any reason why it should slow down. In fact, as more banks which have remained behind in distribution as they pick up pace, and as fintech will now kill distance, and fintech you don't need physical distribution, you can go to the remotest corners. I think this will only gain momentum, so clearly there could be variations year to year, but I think something very important has been achieved, and that is taking equities to the masses. Until 10 years back, they were restricted to the classes only.
So, Prashant, just to wrap it up with one final question. When I started my career, the word which we loosely used on Dalal Street was tip. Now, the tip has been replaced with sip. So, one has to find out a tip how to start a SIP or what SIP allocation should happen from here. What would you advise? I'm asking you this question not only for equity but in general for other asset classes also, because there is a debt, there are balance advantage funds. Is it time to check on the asset allocation now?
Because as we have discussed so many times, and I think you have always kept the focus on the retail investor, and I think it's again a very apt, very uh, good question. See, as we have discussed number of times, the key to equities is getting your asset allocation right. Equities over long periods is like traveling, let's say, in a car. It is moving at 12, 14 kilometers an hour, and bonds are maybe you're on a bicycle moving slower. There is volatility in both, but longer term equities do compound much faster. 4 to 6% or 6 to 8% is what we can expect. And over time, this 4 6% higher compounding leads to great outcomes. As you can see from the journey of Sensex itself, there are many funds in India where NAVs are up 100 times in last 30 odd years. I think there are two ways to invest in equities. One is you can invest lump sum, and I mean nothing wrong with that. If you genuinely feel you look at the value after 5 or 10 years, I think it is perfectly all right. But what happens is that near-term markets are always volatile, and if you invest a very large amount and markets drop, you feel a little more upset, even though you are a long-term investor. I think SIP comes in extremely handy. It's a very simple way to invest. You simply spread out those investments over a few months, quarters, or years. And then even if markets correct, I mean, one, the impact is less because you have not invested all. And two, you are investing at those lower valuations also. So it lowers your average investment index. I think SIP is a great way. It's a simple way to invest, and it also ties in with the monthly income that most of us experience. I think how much SIP you should invest, how much you should invest in equities, I think the answer to that is again very simple. Whatever you invest in equities, you should be able to spare that for the long term, 3, 5 years for sure, hopefully for 10 years. And you should also be able to handle volatility around that. I think if we get our asset allocation right, I think there is no reason why equities will not work for us over the long term.
Well, really appreciate your time. We've really talked about macro, individual sectors, talked about valuation, more importantly, how to choose your asset allocation. Like Prashant said, there are three ways to look at things: valuations, earnings and time duration on that for a long-term investor, even though markets have been very rewarding in last 18 months, I guess the best is yet to come. Really appreciate your time, Prashant, and once again have a wonderful year ahead.
Thank you, Nikunj. Thank you.